Hello, everybody. I'm recording this lecture on December 27th, 2021. This is the second lecture I'm giving on Module 5, Sourcing of Income. And what I want to do now is turn to the sourcing of notional principal contract income. I'm not sure whether you've taken a course in financial products and have studied notional principal contracts. But notional principal contracts are a financial product where the amounts are not real, they're notional. That's why they call notional principal contracts. Well, let's take a look at your book. I'm in section 73.9.2, income from notional principal contracts. Professor Loken writes, income under a notional principal contract usually has its source, the taxpayer's residence. A notional principal contract is a financial instrument that provides for the payment of amounts by one party to another at a specified intervals, calculated by reference to a specified index upon a notional principal amount in exchange for specified consideration or a promise to pay similar amounts. And an example of an interest of a notional principal contract is an interest rate swap. And we're talking about, in the last lecture, we talked about sourcing of interest. So I wanted to cover interest rate swaps. Let me give you an example of an interest rate swap. For example, suppose a US taxpayer, we'll call him T, the corporation T, is interested in converting its $1 billion floating rate debt obligation synthetically into a fixed 3% obligation. It can do that by entering into so the obligation is $1 billion. It paid a floating rate interest, and it was on a real, as a 5-year obligation, and it was on a real floating rate. What it could do is enter into a interest rate swap. Let's have it enter into an interest rate swap with a UK bank. So under the interest rate swap, T, the US taxpayer, will pay on a quarterly basis a floating rate. We have current LIBOR is going out, but let's use LIBOR. Just on some sort of floating rate basis, it pays floating rate to the UK bank on for 5 years on this $1 billion notional amount, and the UK bank in turn will pay US taxpayer. I'm sorry, it will pay it will pay a floating rate. I'm sorry, it will pay, let me check my notes. It'll pay a fixed, feel what I just said, let me clarify this. I got a bit confused. To convert a floating rate debt to a fixed rate debt, it will pay a floating rate to the UK bank. So for a 5-year term on a $1 billion notional amount, it'll pay floating rate. It'll pay a fixed 3% interest on this notional amount of $1 billion. In turn, it will receive a a floating rate on this $1 billion notional amount for a 5-year period. It can use that money in turn to satisfy their the debt holders holding the real obligation. So by doing that, what they've done is they've converted synthetically converted a floating rate obligation into a fixed rate. And most CFOs would prefer, I suppose, to have fixed rate. Again, it's done notionally. If the UK bank were to default, you wouldn't have much protection. because under the regulations, as I mentioned it, 1.863-7B1, generally income from a notional principal contract is from sources in the country the taxpayer's residence. Um, Payments by the U.S. taxpayer T to the UK bank would not have any withholding tax because it's foreign source, and therefore 881 would not apply. So this is a very good result with respect to the UK taxpayer. If the UK taxpayer had been subject to U.S. withholding tax, it would have had to, been paid somehow by the U.S. taxpayer. This is a good result. Again, if what I said to you is not clear, please read the material in 73.9.2, income from notional principal contracts. But the key point is that it's sourced, the income is sourced to the country of residence. So in this particular case, the income receiver, the UK bank, has foreign source income, so there's no U.S. withholding tax. Again, if you have any questions, please email me. What I want to cover next is the sourcing of dividends. In general, pursuant to 861A2 Cap A and 862 little a 2, in general, and there are some exceptions that we'll discuss, dividends take their source from the place of incorporation of the paying corporation. So in general, domestic corporations would pay U.S. source U.S. source dividends would be U.S. source. Foreign corporations paying dividends would be foreign source. This rule is qualified by additional rules that look through the place of incorporation to the underlying operation of the corporation and recast the source of dividends that it pays. Certain gains that are characterized as dividends, such as grossed up dividends under Section 78, we'll come back to that when we talk about the foreign tax credit, or gains from the sales of stock subject to Section 1248, have the same source as though they were actual dividends. Let's take a look at your book, and let's turn to 73.3.1, and let's talk about, well, let's do this first. Let's read 73.3, second paragraph. You read the first paragraph on your own, but I want to highlight the second paragraph. The source rules use the term dividend as it's defined by Section 316, a corporate distribution out of current or accumulated earnings and profits. The dividend source rules do not apply to non-dividend distributions, such as payments to redeem stock and a disproportionate redemption and distributions in excess of earnings and profits. I think you've discussed this, the characterization of what's a dividend in Professor Antonini's course. The rules for gains on sales of personal property provide source characterization for most non-dividend distributions that are included in gross income, such as gains on non-dividend redemptions and liquidations. To the extent treated as a recovery of the taxpayer stock basis, a non-dividend distribution is excluded from gross income, and the source rules, which only apply to gross income, have no application. Let's stop there for the time being and turn to an exception to the sourcing rules. And this is covered in your book in 73.3.1, second paragraph. I'm sorry, 73.3.1. And let's read that. Let's read the first paragraph. A dividend from a foreign corporation is U.S. source income in whole or in part if at least 25% of the corporation's gross income from the preceding 3 years was effectively connected with the trade or business of the United States. This is the first exception. The second exception, too, the dividend is distributed from earnings and profits that the corporation inherited from a domestic corporation. Or the third exception, the dividend qualifies for a dividends received deduction and sources is being determined for the purposes of the foreign tax credit. I wanted to quickly point out to you before we go into depth in terms of the 25% rule, footnote 8 that is in 73.3. Let me read that to you. Footnote 8 says, even if dividends from a foreign corporation are from U.S. sources, they are exempted from withholding tax imposed by sections 871A1 and 881A if the distributed earnings and profits are from a taxable year for which the corporation is subject to the branch profits tax, which generally applies to years after 1986. We'll talk about a bigger exception later, but I just want to point that out to you. So I want to now talk about this 25% rule, one of the exceptions in terms of sourcing. And let's read 73.3.1 and look at the caption, 25% rule. So Professor Loken, I keep on saying Professor Loken, it's Bitgren Loken. I believe Professor Loken, who was my professor way back when in international taxation, wrote the international tax materials, but I'm not absolutely certain of that. So your text writes, generally dividends from a foreign corporation are entirely from foreign sources, unless over the 3 years preceding the taxable year during which the dividend is declared, at least 25% of the corporation's gross income was effectively connected with the conduct of a trade or business in the United States. If the corporation existed for less than 3 years before the declaration year, the testing period is the period of the corporation's existence before the declaration year. If a dividend is declared in the corporation's first year, that year is the testing period. The corporation's effectively connected income for the testing period includes all gross income treated as effectively connected income, excepting gains on dispositions of U.S. real property interest and a few other items. When the 25% threshold is reached or exceeded, dividends from foreign corporations on U.S. source income in amount equal to the dividends multiplied by a fraction, where the numerator is effectively connected gross income for the testing period, and the denominator is all gross income for the testing period. And this is provided for in 861A2B. It covers not just this exception, but the first, in my hard copy of the Internal Revenue Code, 16 lines or so. This provision is provided for in 861A2B. If less than 25% of a foreign corporation's worldwide gross income over the testing period is effectively connected with a U.S. trade or business, or treated as effectively connected with a U.S. trade or business, none of the dividends paid by the foreign corporation is treated as U.S. source income under this provision. So you have to meet this 25% threshold in order for this provision to resource income from dividends from a foreign corporation and make that U.S. source. Income that is U.S. source, but is also not effectively connected with a U.S. trade or business is not included in the numerator of the fraction. So that would not work to convert dividends from a foreign corporation to U.S. source. As I said, the testing period is a 3-year period ending with the close of the corporation's taxable year, immediately preceding the declaration of the dividend or such part of such period as the corporation has been in existence. If the foreign corporation has no gross income from any sources for such testing period, the relevant testing period becomes the taxable year in which the dividend is paid. If the 25% effectively connected income threshold is met, the dividends paid by the foreign corporation are treated as U.S. source income in an amount which bears the same ratio to such dividends as the corporation's gross income for the testing period, which was effectively connected income or treated as such, excluding certain types of income as described excluding certain types of income, bears to the gross income from all sources for such period. Let's do an example. If a foreign corporation's relevant effectively connected income is 40% of its gross income from all sources over the testing period, then under this provision, 40% of the dividends paid by it are treated as U.S. source income. Very importantly, the 25% rule for dividends from foreign corporations has relatively less relevance today because of the enactment in 2004 of sections 871 I2D and 881 little d in parenthetical. These were added by the American Jobs Creation Act of 2004. Under these provisions, payments after 2004, for payments made after 2004, the 30% withholding tax, that's imposed under FDAP, so U.S. source dividends, will not apply to the portion of the dividends of a foreign corporation which are treated as U.S. source income under the 25% source rule and paid to a non-resident individual or a foreign corporation. So you might want to read on your own 871 I1, then 871I in parenthetical, 2 in parenthetical, and cap D in parenthetical, and 881 little d. But the bottom line here is that a major problem of U.S. sourcing, which is to expose non-resident alien individuals and foreign corporations to U.S. source FDAP withholding on dividends, does not apply to dividends that become U.S. source by virtue of the 25% rule. I wanted to cover inherited U.S. E&P from foreign corporations. But before I do that, I just want to quickly mention something. It's covered in 73.3, second paragraph. I think it's the 5th sentence. Professor Loken writes, if a transferor of stock in a securities lending or sale repurchase transactions receives payments as substitute for dividends on the stock, the source of these substitute payments is determined as though the payments were dividends on the transferred stock. For example, if a brokerage customer lends stock of a domestic corporation to a U.S. broker, e.g., for example, for use in the short sale by another customer of the broker, the agreement between the broker and the customer likely requires the broker to make payments to the customer equal to any dividends paid on the stock while the loan is outstanding. Because the subject of the loan is stock of a domestic corporation, these payments, these substitute payments, are from U.S. sources. If the customer is a foreign person, the payment is subject to U.S. withholding tax. I'm not sure, again, if you've taken the course in financial products, but a taxpayer may sell stock short if it expects the stock to go down in value. So often with a stock sale, you borrow the stock from a broker that you sell short, and the broker will be expected not only to get the stock returned to it, but a fee for what it's done, as well as a substitute for the dividends for which it would have received. It would have received these dividends had it not lent the stock to the customer who is selling the stock short. And that's what this is all about. All right, let's talk about inherited earnings and profits. This is covered in your book in 73.3 under the caption Inherited Earnings and Profits. So it's, I'm sorry, let me get the right site. I'm sorry, it's 73.3.1. And you look at the caption, Inherited Earnings and Profits. Let's read that. If a foreign corporation succeeded to earnings and profits of a domestic corporation by a reorganization or liquidation, dividends distributed by the foreign corporation from these earnings are U.S. source income. Okay, let's now turn to another provision. This is provided for in 73.3.1, the caption, dividends received, deductions allowed. And this is covered also in 861A2B. In my paper version of the Internal Revenue Code, it's the last 9 lines of 861A2B. The provision was added at the time of the enactment of Section 245, which I think you've studied in Professor Antonini's course, essentially to preclude both a foreign tax credit and a dividends received deduction under Section 245 attributable to the same income. And let's read through the material in your book. I think Professor Loken does a great job. So Professor Loken writes in 73.3.1 under the caption, dividends received, deduction allowed. Let me just take a drink of water. If the recipient is allowed a dividends received deduction for a dividend from a foreign corporation, the source determination is coordinated with the deduction mechanism for purposes of the foreign tax credit. Under Section 245(a), a corporation is allowed a dividends received deduction for dividends received from a foreign corporation if 1, the taxpayer corporation owns at least 10% of the foreign corporation stock, both by value and voting power, but less than all the stock. 2, the foreign corporation is not a passive foreign investment company, a PFIC, And three, some portion of the corporation's post-1986 undistributed earnings consist of effectively connected income or dividends from a domestic corporation, at least 80% of the stock of which by both vote and value is owned by a foreign corporation. When these requirements are met, the dividends received deduction equals a stipulated percentage of the portion of the dividend that is ratably attributable to the distributing corporations post-1986 U.S. undistributed earnings, including both effectively connected income and dividends from domestic subsidiaries. The stipulated percentage is 65% if the taxpayer owns at least 20% of the distributing corporation stock and is otherwise 50%. So, if the corporation owns less than 20%, the DRD, dividends received deduction, is 50%. For purposes of a foreign tax credit, a dividend qualifying for the 245(a) deduction is from U.S. sources to the extent it is from the distributing corporation's post-1986 U.S. undistributed earnings. If the 65% deduction is allowed, the U.S. source portion is 100 over 65 of the deduction. If the 50% rate applies, it is 100 over 50. 100 over 65, 100 over 50, functions to gross up the deduction amounts to derive the full dividend eligible for the 245 dividends received deduction that will now be U.S. source. Professor Loken goes on to write, for purposes of the foreign tax credit, a dividend qualifying for, I think I read that, did read that. Let's go through this example. Assume domestic corporation P receives a $100 dividend from foreign corporation F, of which P is a 40% shareholder by both vote and value. Because it's a 40% shareholder, under 245, it receives the 65% dividends received deduction. He goes on to write, has post 1986 undistributed earnings of 1,000, of which 300 consist of income effectively connected with a U.S. business of F. F owns no stock of a domestic corporation. Because 30% of F's post 1986 undistributed earnings derived from effectively connected income, 30 of the $100 dividend comes from post 1986 undistributed U.S. earnings. Because D owns more than 20% of F stock, the dividends received deduction is 19.5. That's the 65% of the $30 received from post 1986 undistributed earnings. The U.S. source portion of the dividend is 30, which is 100 over 65 times the 19.5 dividends received deduction. Hope that's clear. If it's not, by all means, you can email me. Importantly, just like with the 25% rule, 25% effectively connected income rule, dealing with sourcing of dividends, if this provision on dealing with dividends received deduction in the second part of 861, little a, little 2, little cap B applies, and treats the foreign corporation dividend as in part domestic source, then there would still not be any withholding for FDAP purposes under 871 I2D and 881D, right? So this would still turn off FDAP withholding, which is really important. It still, however, becomes U.S. source for other purposes, like for foreign tax credit purposes of 904. All right, let's move on. I want to cover one more topic in this lecture, which is the sourcing of personal services. And Professor Loken covers that and let me get it in front of me, in 73.4, generally, and this is important, the source of income from personal services is the place where the services are performed. This general rule reflects an identification of income with the activity giving rise in it. So if you perform services solely in the United States, it's US source income. You perform services solely outside the United States, it's foreign source income. When services are performed by an agent, the place where the agent acts, not where the principal resides, determines its source. You look to where the agent acts. There's an exception from US source for compensation for services of a foreign individual present in the United States for 90 days or less during the taxable year, meeting certain requirements. Let me see if I can get this in front of I'm looking for the exception in your book. Let's bear with me for a second. Well, Loken mentions this in 73.4.1. He writes, compensation for labor and personal services performed in the United States is from US sources, except that a foreign source label is applied to compensation for certain services in the United States performed by a non-resident alien temporarily present in the United States for not more than 90 days during a taxable year, and non-resident alien crew members on foreign vessels. So these are two exceptions. Let's just quickly go through this 90-day exception. It's not very important, as we'll see. For this to apply, again, the individual can't be present, only can be present for 90 days or less during a taxable year in the United States. The services are performed for a foreign employer not engaged in a trade or business in the United States, and or for the foreign office or place of business of a US person. And the total compensation for services got to be 3,000 or less. This is why this is not, very important today. This was known as the commercial travel exception. This provision is designed to enable foreign individuals to make short business and professional trips to the United States without US tax consequences. The $3,000 limit, which perhaps was adequate when this was first enacted, has been reduced to a whisper by inflation, and this will not apply to in most circumstances to engineers, accountants, executives, etc. And this is in fact covered in your book in 73.4.3. This is what I was looking for before, second paragraph. And let's read that quickly. Yeah, so Loken writes, under 861A3, compensation for services performed by a non-resident alien individual in the United States is foreign source income if all the following conditions are satisfied. One, the service performed while the individual is temporarily present in the United States. Two, the individual is present in the United States during the taxable year does not exceed 90 days. Three, compensation for services does not exceed $3,000, or for the service performed by an employee or independent contractor of one, a non-resident alien or foreign corporation or partnership that is not engaged in a trade or business in the United States, or two, an office of a U.S. citizen or resident or domestic corporation or domestic partnership in a foreign country or U.S. possession. As Loken points out in this provision, tax treaties will generally provide a much more expansive exception, and that is discussed in your book in 73.4.3. There's another exception for U.S. Source income for services of non-resident alien crew members in foreign vessels engaged in transportation between the United States and a foreign country or possession of the United States. This is covered in 861A3, last sentence. This is dealt with in 73.4.3, last paragraph. Let's read that. A more specialized statutory rule provides for compensation for a non-resident alien individual service in the United States is foreign source income if the services are in connection with the individual's temporary presence in the United States as a regular member of the crew of a foreign vessel engaged in transportation between the United States and a foreign country or U.S. possession. Wages of alien seamen earned on a coastwise vessel, in contrast, are from U.S. sources. Okay. So as I said, let's turn back to 73.4.1, first and second paragraph. Compensation for labor and personal services performed in the United States is from U.S. sources, except that foreign source label is applied to compensation for certain services in the United States performed by non-resident aliens temporarily present in the United States for not more than 90 days during a taxable year, and non-resident alien crew members are on foreign vessels. Compensation for services performed outside the United States is foreign source income. The residence of the recipient of the service, the place of contracting, and the time and place of payment are irrelevant. You look to where the services are performed. Special rules govern the source of income from transportation and international communication activities. We're not going to be covering that. The place of, Loken goes on to write in 73.4.1, second paragraph, the place of performance principle applies not only to individuals, but also to corporations and other employees. And it reaches advertising income, sales commissions, and amount received under a covenant not to compete. We'll see that. I've asked you to read a case, International Multifoods, and one of the issues which really was not contested was the covenant not to compete. So if a covenant not to compete covers an area outside the United States, it's foreign source. When you read the case, what was contested there was not that the covenant not to compete did not generate foreign source income, but the IRS argued that the amount allocated to the covenant not to compete was too high, and the court agreed that it should be decreased. So please read that case. I did assign that to you along with the Boulay case. a major problem in applying the sourcing rules is where the individual or corporation or other entity is performing services in the United States and outside the United States. And how do you properly bifurcate the sourcing of that income? And this is covered extensively in your book. I'm going to highlight some of what I find to be the most important parts of that. So under the regulations, an individual receives compensation other than an individual who receives compensation other than compensation in the form of certain fringe benefits as an employee. So an individual who's receiving compensation, not certain fringe benefits, as an employee for performing personal services, partly within and partly outside the United States. The rules under the regulations is that the sourcing should be done generally on a time basis. So let's give an example of that from the regulations. Suppose we've got a non-resident alien, we'll call him B. He was employed by a domestic corporation, a US corporation, for 300 days during the taxable year. During this period, Mr. B performed services for the domestic corporation in the United States for 180 days and performed services outside the United States for 120 days. So, 60% of the services performed in the United States, 40% outside the United States. And so if the compensation was $80,000, then 48,000, 180 over 300 times 80,000 would be US source, and the residual 32,000 would be foreign source. The regulations also note the sites and the regulations provided for in your book. Let me get it in front of me. This is 73.4.2, and we're really going through the 73.4.2.1. This is the 861-4B regulations. The regulations also note that for non-employee individuals, by that I mean independent contractors and for corporations, while using time to allocate sourcing may, in certain circumstances, be appropriate. It may not be the best method in all cases. And so what the regulation says is you need to look at the particular facts and circumstances. And they give an example as to why time may not be the best method of bifurcating sourcing between US and foreign, in cases not involving a US individual employee. And the example in the regulations, Corporation X received compensation of $150,000 for services to be performed in the United States and abroad. The number of employees and the number of hours worked are equally divided between the United States and the non-US locations. But the pay to US employees is higher because the services they perform are considered to be more sophisticated. So suppose the US payroll cost in this example was 20,000 in the United States, 10,000 outside the United States. What the regulations tell you is not to allocate the sourcing 50-50 on a time basis, but instead based it on the cost. And here the payroll cost in the US was 2/3 of the total. Therefore, 2/3 of the $150,000 of revenue have to be treated as US source and 1/3 foreign source. I hope that's clear. Under these regulations, even for an individual receiving compensation as an employee, if the individual can establish to the satisfaction of the commissioner that an alternative to time is a better method, then it's permitted to use a method other than time. Let's address fringe benefits. And let's talk about, let me find the right page here. I want to talk about stock options. And stock options is covered in 73.4.2.2. I believe it's the 5th paragraph. I'm going to try to find it myself. The paragraph begins, compensation in the form of a stock option is normally attributable to the period beginning with the date of the option's grant and ending with the date on which the employee satisfies all employment-related conditions for its exercise. That is the option vest. So that's the period you look on the granting of stock options. You look at the period, where were the services performed, from the period beginning at the time the option was granted and ending with the time the option vests. That is where it's no longer, it can't be forfeited. For example, if the employee were to leave the company. And Professor Loken gives an example at that section, and let's read that. Assume X corporation grants a non-statutory stock option of employee on the first day of the calendar year to purchase 100 shares of X stock for $5 per share. Let me stop for a second. There are different types of options. There's something known as an incentive stock option, ISO, and there's also non-statutory stock options, an option that doesn't meet the requirements for being an incentive stock option. So the example concerns an option that's non-statutory, doesn't meet the requirements of an ISO. So he goes on to write the following. I'm going to repeat it. I forgot where I broke to tell you what a non-statutory option is. So again, he writes, assume X corporation grants a non-statutory stock option to employee on the first day of the calendar year to purchase 100 shares of X stock for $5 per share. The option will become exercisable 5 years after it is granted, but only if E is employed by X or an affiliate throughout this 5-year period. T works for X throughout the 5 years and exercise the option during the 6th year when the stock is worth $10 per share. As a result, she has compensation income for that year of $500, 5 times 100. Her work is exclusive to the United States for the first 3.5 years. The first 3 years, I'm sorry. Her services of the 4th year are performed in the United States for half a year and outside the United States for the other half a year. And she works only in the foreign corporation during the 5th year. The applicable period is the 5th year, is the 5-year period. beginning when the option was granted, ending when it became an exercisable, because T during the 5 years performed 3.5 years of services for X in the United States and 1.5 years outside the United States. 70% of the income, 3.5 over 5 is U.S. source, and the remaining 30% is foreign source. Hope that's clear. Again, if it's not, by all means, email me. I hope also to try to have some synchronous sessions where we can see each other. So I'm going to try to get that done as part of the course. I think that will be helpful in answering questions. I understand that from one of my colleagues that 9:30 in the morning, my time, is 8 p.m. your time. So we will work toward that when this goes live. Let's take a look at 73 4.2.2, talking about fringe benefits in general. I'm in the 6th paragraph. I'm sorry. I'm in the 6th paragraph of 73.4.2.2 of your text. Let's read that. Let me take a drink of water first. The source of taxable fringe benefits is usually determined in the same way as the source of wages and salaries. However, the source of 6 types of taxable fringe benefits, including housing, education, local transportation, tax reimbursement, hazardous duty pay, and moving expense reimbursement benefits, are determined on a geographical basis. The meaning of a geographical basis varies from one fringe benefit to another. For example, the geographical source of housing, education, or local transportation fringe benefit is a taxpayer's principal place of work. So let's go on. He says in little a housing fringe benefit may only include payments to on behalf of an employee and family members residing with the employee for rent, utilities, other than telephone, property insurance, non-deductible occupancy taxes, non-refundable fees for securing a leasehold, rental of furniture and accessories, household repairs, residential parking, and the fair rental value of housing provided in the kind of employer. Let's turn to B. An education fringe benefit is an employer's payment of education cost of an employee's dependents, including tuition and other educational expenses, regardless of whether incurred in connection with the enrollment or attendance at a school, and cost of room, board, and uniforms at an elementary or secondary educational institution. By the way, the big picture here is these are all governed not where the service is performed, but the source based on principal place of work. So if your principal place of work with the United States, housing, education, the next one will deal with transportation, all becomes your source. If your principal place of work was outside, then the source of all 3 of these would be foreign source. Let's read that C in that 6th paragraph in 73.4.2.2. A local transportation fringe benefit is compensation for local transportation of an employee and his or her spouse and dependents at the location of the employee's principal place of work, including only actual expense of local transportation and the fair rental value of the vehicle provided by the employer and used primarily for local transportation. The significance of source rules for housing, education, or local transportation fringe benefits is that all of such benefit is from sources in the country of the principal place of work, even if some of the employee's work is done elsewhere and his or her salary is thus not entirely from sources at the principal place of work. And in the next paragraph, Professor Loken writes, a source of tax reimbursement fringe benefit is the country or other jurisdiction that imposes the tax. A hazardous or hazardous duty pay fringe benefit has its source at the location of the hazardous or hardship duty, and a moving expense reimbursement is usually from sources in the country of the new principal place of work. I just wanted to briefly touch on qualified plan benefits. This is covered, I believe, in 73.4.2.3. And let's read the first sentence or so. Benefits under a qualified pension, profit sharing, or stock bonus plan are one from U.S. sources to the extent they consist of employer contributions for services in the United States. Two, foreign source to the extent the employer contribution for services outside the United States, and U.S. source to the extent the benefits consist of earnings and accretions and contributions of either the employer or the employee. This would deal with the defined contribution plans. So when you study that, defined benefit plans are more complicated. You're welcome to read the material in the Loken book. I will certainly not test you on it. I think I'm going to stop here, and we'll continue the lecture at a later point. You know, we've got an additional lecture or two dealing with sourcing of income, but let's stop at this point. I hope you have a great day. Take care, everybody. Bye.